Ladies and gentlemen, welcome back. It is time for our December edition of our strategy meeting. This is where our trading team gets together and talks about some key themes that they may be seeing over the course of the next month. In this case, it might be over the course of the next year, as we might do a little bit of a prep for 2021. I'm going to welcome in all the gentlemen, and I'm going to roll things out with Brett Manning, aka Chart Trader. How are you today, Brett?
I'm doing pretty good, Jim. How are you?
I'm doing all right. Hey, right process on that crude oil trade. I think you might have got popped out a little bit, maybe a little too tight, but
Yep.
um, the process was there. The market
Yeah.
is now trading positive. Last I checked, yeah, it's up
Yeah.
about a
And you know
quarter.
what? Really, we got the initial knee jerk down, and then we beat that low again, and I saw nothing kicked out, and I really thought there must be so many people loaded up short. I'm surprised they were able to get that third shakeout low, which took my stop out before the inevitable, I think, which is the squeeze here.
Yeah, and that put in a low just below 45 too. So I bet you what they were trying to do was shake out the stops at the 45 print, and they only got about 5 cents worth of selling.
Yeah.
And right from there, now here we are trading in positive territory. We're up about 30 cents in crude oil. Would you go back after it?
It depends on the setup. I have a bias, so as we've talked before, I separate it into two steps. I have a directional bias and I have trading setups. Things that I look for in particular. So at this point, my bias is higher because if that data can't shake this market out, then there's a positioning problem where it's going to be really tough for it to move lower. And we could get, and you've seen this so many times before, next week's print could be the opposite data. And really, you just have a time issue. So I mean, with exports, when they're actually processed, when they're dated, that inventory level could actually really be because of a scheduling situation. But it was about as bad a face value print for inventory data as I can remember ever seeing, and the market's positive right now. So that's my directional bias indicator. Now I just need to see a setup that I'm comfortable with, where I feel like there is a risk reward situation that works for me, and my sense of the probabilities attached to the pattern work out. It just depends on how it builds out. Let's see if we get some resistance to set up here. We maybe get a couple attempted shakeouts, form higher lows, maybe something like an ascending triangle under 46. I'd possibly go after that.
All right, so hold that thought. I want to come back to crude in a moment. However, we got a real-time trade with Scalp Trader. You went long LAZR again. You're getting back in. Damon, since I have you on, why don't we talk about it?
Sorry. Yeah, thanks, Jim. Yeah, so just looking to play a squeeze here. I know Citron was out negative on this yesterday, and a lot of times you'll see people short these names in response to the reports. Stock was a little bit overvalued, had gotten ahead of itself, and just looking to play a quick reversal here. Name like this, momentum players get behind it on a bounce. It can recover pretty quickly. I mean, could bounce 2, 3, 4 points. So just looking for that initial squeeze opportunity.
All right. So I want to circle back to Brett and have a little conversation about it's not necessarily a 2020 theme or a 2021 theme, Brett, and that is this surge of demand in electric vehicles and maybe lithium batteries and whatnot. And I'm curious because you have kind of a futuristic outlook, I would say, and I would really love to get a handle on what your thoughts are in regards to the crude oil market. Now, if we have this pickup of production of EVs over the course of the next decade, at some point there's a tipping point where crude oil loses its relevancy in the market. And I want to know where you suspect that might come into play and when might we get an opportunity to trade lithium, because I would guess that that might be a very hot market to trade in the coming years.
Yeah, so there's a couple points there, and it's something that I've given thought to. So the electric vehicle trend, I think that right now they look for peak demand for oil based on transition to electric vehicles to be somewhere around 2030 to 2035. I suspect that's too far out because I think we've talked about this stat before, but over the next 10 years, a total of I think $68 trillion is supposed to pass to millennials and Gen Zers through inheritance, and the purchasing power shift there is probably a lot bigger, and we know what the preference there is in terms of consumer choices in vehicles. So probably they're underestimating the pace of that shift. However, I would also caution the idea that that makes oil disappear, because really what it means is we just pass the point called peak demand, the greatest level of demand the world will ever have for oil in a day. There will be a day that's that day. After that day, oil doesn't disappear, it steadily declines in demand. But because the price is a function of supply and demand, what you'll simply get is, some kind of recognition by the market that we're past that point, and then supply will fall off. You could even see the price of oil rise dramatically after that if people stop investing in developing oil, because it will still be needed for many things. So it's really difficult to say that does that mean oil disappears off the map. I think it's a long, slow decline, something like we had in like whale oil 100 years ago. That was a really important market for 50 years, and then it just kind of, gradually fell off because there were other substitutes that were more effective. So it doesn't necessarily mean crude will go away. It will stay a very active market, and the price could even go higher after this process. But the other part about that is the whole infrastructure around policy and institutions. I think I started talking about OPEC disappearing in 2014. I think that we're gradually going toward OPEC disappearing. The main thing, the OPEC plus shift, is really the start of the end of that situation, because quite frankly, there's the envelope of the pie of global production is too diversified at this point to manage with a small group of countries. So they have to start adding countries, and eventually you're going to have to add the United States, but you can't because of antitrust laws. So it's not a tenable structure in the first place. And if we're gradually getting to the point where oil is not necessarily the one most important commodity in the world, then there won't be any point to it either. So I would imagine this is the beginning of the end of OPEC existing. But one other question you asked me before is, what does that mean about the possibility for lithium futures? And they're already ready to launch. As I understand it, the London Metals Exchange is going to launch a lithium market in the first half of next year. And the way this sort of process happens is you get a commodity that's obviously an important commodity. It's rising in relevance, but you have different areas in the world that produce it, and they have different local markets with different pricing. So before you can get a futures market, you have to get a kind of uniformity, a sort of fungibility across that whole spectrum to build a fix for global reference pricing. And as I understand it, the London Metals Exchange has been working with lithium producers to put a fix in place through some third party, and I suppose that from what I've seen, that's close to happening. It'll probably be really illiquid at first, and probably will remain a small market because there's just not that much lithium, but it's set to become another futures market that exists probably within the next 6 months.
All right. And if I'm not mistaken, is the bulk of the mining going on in Australia?
I don't know the answer to that. I know Canada's big in it as well. I could certainly believe Australia, and I could certainly believe Sub-Saharan Africa. But I would have to look. I don't know. I know that there's a number of different major centers that produce small amounts, and it's diversified. And there's some human rights issues there, especially when you get into some of the areas in Central Africa. But that likely would be something that would cure itself with the establishment of a global futures market.
Were you guys talking about lithium here?
Correct.
Yes.
Australia is. Chile's second, actually.
Gotcha.
All right. So I would suspect that a long-term Aussie dollar trade might be in the works. Brett, what do you think?
Well, there's other considerations, but yeah.
Event trader here. One thing I'd add to that Australia too for miners, one that I'm looking at is the uranium miners CCJ, because the bill was passed on Monday by the Senate committee. That's why we're seeing a breakout in these uranium miner names for stockpiling here in the U.S., which is helping drive Australia. So not only lithium, but uranium too for Australian miners there.
All right, and one more thing. I don't want to have this conversation dominated by Brett, but this goes out to everybody, because one of the themes that we were talking about all year was the risk of inflation. Now, China had a data point last night that was really low. In fact, their CPI fell, and believe the expectation was for growth of 0.8%. It fell 0.5%. So does this kind of throw a little cold water on the inflation story yet?
I can take this. I mean, I think that it's going to be a long, slow process. I mean, I think you're not going to see data points necessarily right around the corner, especially with the limitations that we have in a pre-vaccine world. But I think the most important thing is the cake baking. If we get past the point where we're not removing any of the stimulus, we've already said we're not going to for a long time, and if we have a true kind of old school cyclical recovery reflationary situation, which all indications point to that's what's happening right now. And if we have a monetary policy shift and a fiscal policy shift that's happened where we're so scared of the deflationary boogeyman that people are really, really, really willing to do things like average inflation targeting. Let's let it go to 3%. Let's let it go to 3.5%, because so many times we've been burnt by tightening too early and we put ourselves right back into a deflationary risk situation. There's a kind of muscle memory going on here in policymakers around the world. And so that would suggest the possibility that the cake is baking. And you're not going to see the data for a while, but it's really trying to understand, whether or not we're in a situation where the world is becoming more and more pregnant with future jump in inflation. I don't think you're going to see the data tomorrow, though, that confirms that.
Well, not tomorrow, but I was definitely surprised to see the print that we saw last night. Now, I guess you could always say that in China you could see things pop pretty quickly, and we could see the exact opposite print and see a big increase in inflation in 1 month's time. So I guess you never really can tell, and one data point doesn't make a trend, but it was worth noting because you would expect inflation of all the places to be hopping in China. I thought that would probably be the leading indicator as opposed to maybe a lagging.
Can I steer things a direction here real quick?
Please.
I just to run through it, I want to just point out some of the things that I've been talking about on the site in terms of sentiment data, just in a really quick summary, just so I give the perspective that goes behind some of the things that I've been talking about under my chart trader ticker. So right now we're at the point that I see as very similar to what we saw in mid-December of 2017, where we were already at multi-year and in some cases multi-decade extremes in certain sentiment data indicators that cover enough of a different range of points. You've got options data, you've got cash and portfolios, you've got hedging indexes, you've got surveys, you've got positioning. All of these things are lined up in a way that suggests that right now already everybody is very much on the same side of the market. And that creates a risk, but not necessarily a shift. Or it's not necessarily that it'll happen tomorrow or the next day, but it has to be reconciled in some form. And so it's similar to what we saw, I think, in December of 2017 when we just got in the tax bill and there was just this raging parabolic move that happened after all those extremes into January and into the end of January, and then we got just a monumental crash in early February when eventually we poked it. We just pricked it. And once everybody's holding no hedging and everybody's levered up on the same side of the market, the second that type of situation gets perturbed in a negative way, then everybody starts to turn at the same moment and look for some kind of protection, but there's no floor there because nobody's on the other side of it. And we're building a situation like that right now. It doesn't mean I want you to go out there tomorrow morning or this afternoon and just start building short exposure every day, because this sort of thing can move to greater and greater and greater extremes before eventually it folds. It's better to look for starting to see the signals of the folding, starting to understand. In 2018, we actually, in early February, we caught that reversal really well into the crash because we waited for just after the mega cap tech companies to come out with their earnings reports, and there was really no other major catalyst in front of us, and we had basically a bubble in short VIX instruments. So that was really kind of the final capper of no protection, and when the market went, it fell about 10% in 2 days. And I feel like we could be building towards something similar right now, but again, that doesn't mean that you just start to naked short fade. Anybody?
Oh, yeah, sorry,
no,
my mic was off. Apologize. Yeah, here I am rattling, talking to myself. All right. So actually what I wanted to do was bring Scott into the conversation because you've been dabbling a little bit with shorts, mostly as a hedge. Do you agree with Brett's sentiment there? And is that why you're dabbling a little bit in the IWM short, triple Q short, and whatnot? That went to blue chip.
All right, I can jump in here. I think Scott might just be having an issue
No,
with his mic.
I'm here. Sorry. I'm literally chewing on something as I was talking. I wasn't ready to be called in. Sorry. What was the question again? I literally was choking on my food as you called me.
We were talking about Brett was talking about the building sentiment and people being unhedged, but I was noting that you were starting to dabble in some shorts with IWM hedge, triple Q hedge, and whatnot, and just wanted to get your thoughts.
Yeah, again, I've been really more short-term tactical trading oriented here the last couple of weeks. It's typically the way I tend to behave around the holidays, going into Thanksgiving and between Thanksgiving and Christmas. Yeah, I mean, everyone knows that the sentiment's very bullish. You can look at AAII data survey. You can look at fear and greed indices, and just the markets, just the way they're trading at their highs. It does look like they're losing a little bit of momentum lately. The last couple of sessions here, give or take, it seems like very specific trading by appointment only sort of mentality here, where some headlines are the key drivers behind a lot of let's just say small cap names, and then you have a couple of really hot spaces like the electric vehicle spaces, as well as the SPAC plays that seem to be, pretty much taking all the attention for traders here into year end, because they're creating a lot of volatility and there's a lot of opportunity to, window dress those portfolios. But overall, you look at the big tech names and everything else, it's just kind of a little bit of sluggish behavior there. When you look at stocks like NVIDIA, that's been going sideways for about 4 weeks now. Microsoft, really similar pattern, just going sideways for a couple of weeks now. You're just seeing these big behemoths in the major indices just really kind of become a little bit of a slowdown going on there. It's some sector rotation and stuff like that, but I just think it's a lot of wrapping things up, year-end strategies and stuff that's in play here. So with that in mind, with the sentiment so strong, it doesn't mean that the market's bearish by any means. Price is the leading indicator, and you need to see price itself break down below weekly support levels, below key moving averages, to really see the distribution take hold. And as Brett was just saying, this trend in play, we can continue to just grind our way higher and higher without any sort of real sort of breakdown or correction, despite the fact that sentiment's been running pretty high. Now, on a short-term tactical basis, any sort of gap up in the market that's looking pretty extended after a 3-day run-up, I think that's fair game to kind of nibble on the short side there, maybe lock in some profits, protect some of your gains on the long side that you've been having or holding, and that's really more of the strategy that I've been taking here with, I just went back into a short in the IWM. And it's just something that I just feel like, the market's looking a little bit overextended at this point in time. Mid-December, from a seasonality basis, tends to be a little sluggish. So we did have a nice start here for the first few days of December. But I think things are just pretty much ready to settle down a little bit. Perhaps these IPO debuts with Dash and Airbnb today, maybe they've been so hyped up that maybe this kind of puts a little bit of a stop to all the craze and mania here for a few days. And then, things will settle down, and then maybe we get some sort of pullback that can turn into some sort of Santa Claus rally around the Christmas holiday. So that's really... that's really what I'm looking for. But the key thing for me overall is just I'm not bearish, but I'm just following the flow of momentum. I'm following the money flows here and following the different stocks that are in play, and just kind of going with it. And it's been working out, better than it normally has. So it seems like that's where all the attention is, and that's where all the flow is going these days.
Brett, you wanted to chime in? Did we lose Brett Manning?
It seems like all of us are eating.
Yeah, no, sorry. Had the mute button on. We got to disable that thing. So, okay, so yeah, I just wanted to add something to complement what Scott was just saying, and I really like the trading by appointment statement because honestly, the intraday action feels to me across the market kind of like that, and I think part of it is trading in the shadow of the stimulus negotiation. But he's right. Price is the ultimate arbiter, and when price starts to change, when there's something that changes about the way the market is trading, that's the big signal. However, the angle of adding in sentiment data. So what I look at is something like the Lobo ratio, which is the large only buy to open put call ratio. It shows larger players in the options market and whether they're buying puts and calls. The Robo ratio, which is the smaller traders in the same way. Cash in portfolios from portfolio managers. The equity hedging index, which takes 6 different measures of hedging. Several different surveys. And when they all start to line up, the difference is if you have a neutral sentiment market or a market where people are a little bit cautious and you see price start to break levels, the follow through is probably going to be minimal because everybody is sitting there with some cash on hand. They've got some puts in the portfolio. They've got some shorts out there. They've got some hedges. So when price starts to go south, people don't panic because they've already got some protection and there's not that much work to be done to adjust exposure to get into a more cautious framework. However, when everybody's on the same side, so the Lobo ratio is at a 20-year low. It's been 20 years since we've seen large options traders have so many calls and so little puts. Robo ratio is at its lowest level since late 2007, right before the 2008 crash. B of A cash in portfolios at 4%, which is extremely low historically. So big portfolio managers are just cash poor. Equity hedging index is one tick above a super bearish extreme. The National Association of Active Investment Managers is at multi-year highs in terms of exposure and leveraged exposure. The AAII bull ratio is at a bullish extreme. All these things are lined up right now, kind of all saying that if we do start to see that shift, so price doesn't have to change, but if we do start to see it, we do start to see important levels getting broken, then suddenly, because of this kind of internal guts of the market, sort of positioned in a way where everybody's loaded up on calls, nobody's got any cash, nobody's got any puts. The second those levels start to break, the problem is in this sort of situation, the vulnerability is greater in terms of what will happen in terms of downside follow through because there's so much more work to be done to adjust to a more neutral stance.
All right, Brett. So everyone's going to want to know what are some of the risks out there that could potentially cause this little prick in the markets and maybe be the catalyst for such a sell-off.
Well, and that's the problem. The reason why everybody's positioned this way, it's not random. They're positioned this way because we have such amazing levels. So Gavin posted an article the other day from the Wall Street Journal showing that we've got negative rates on corporate debt right now, negative real rates. Right? And that's never happened before. But that's because we've got so many programs coming in to eliminate default risk because of the pandemic. And we've opened the fiscal channel. We've got the Fed working hard at it. So default risk drops out of the equation. So those rates pin themselves to treasuries. So treasuries are at negative real rates, and now corporate bonds are at negative real rates. That's a symbol of what's happening. That's why everybody's on the same side, because it's hard to imagine anything that could go so wrong as to not already be taken care of. However, I've seen that kind of situation happen a number of times, and there's always something that can come along. And it doesn't have to be that big a deal. It just has to shift the psychology for a moment. And when the psychology changes, then it becomes this could be a big shakeout that just shoots right back to the highs once people rebalance. But the pain is what causes it. It's not the outside catalyst. The vulnerability is there. Who knows what it will be that's the outside catalyst? Something can just kind of get a feedback loop going. And then the pain from that positioning, people are levered up and they suddenly get out of the money and they don't reason anymore. They just know they need to change to stop the pain. And everybody turns and does that at the same time. That's when you get that air pocket in the tape. So we're positioned for that possibility. Again, this could go parabolic for the next month before it happens. Something has to reconcile this level of one-sidedness in the market. It doesn't have to be an external catalyst. It just has to be the process, whatever it is caused by, that sets off that kind of feedback loop and shift in psychology.
I'll tell you one of the processes that I've seen over my time is that anytime there's been some type of change, like the president or the Fed chair, the market seems to want to test the resolve of, I don't know, the leadership or what it may be. But if you think back to different times in history, recent history, where we've had some type of leadership transition, we've had some type of big fallout. You can go back to the George W. Bush days. Obama had it. When Janet Yellen became the Fed chair, she had something going on where the market really did test the resolve of investors to see what was going to happen. And we didn't necessarily know what these things were going to be, but they did happen. And it just seems to be that anytime there's a leadership change, we have something that occurs, we see a big dip in the market, and that might be something that could happen in the early portion of 2021.
It could be, but you also could see this as a restoration of leadership. In other words, they're familiar with the players again. It may not be tested in the same way. I mean, it depends on what they do with the Fed, but Biden is a known quantity. Yellen is a known quantity. She's back at Treasury. Fiscal is going to be more important now. So it's not really necessarily a new cast of characters. It's a restoration of a previous cast of characters.
Man, you always got to be a buzzkill, Brett.
That makes sense to me. I like to be contrarian. Say what you want, I'll argue with you.
That's true. That's true. All right. So where do you want to go with this conversation? I know being that we're heading into 2021, you guys got to have some big themes and some big ideas. What are you looking forward to as far as decent trading opportunities?
I'll jump in here.
Go ahead.
This is SCALP. And, again, I still think that SPACs are going to be a great opportunity. We had a little bit of a shakeout in October, and I think that'll happen again. We're starting to get overheated in the SPAC space. A lot of big movers. I tend to I like the warrants in the SPACs in particular because you can literally make 10 times your money over the course of a few weeks. And so if you look at the warrants in some of these names, a lot of times you're able to buy the warrants for $1 to $2, and there are warrants that are trading at $20-25 right now. So it's a good way to get really compelling leverage to the upside in some of these SPAC names. Momentum money loves this type of stuff, whether it be an IPO or a SPAC. The reason I like SPACs a little more than IPOs is that, as you see from some of the deals, the IPOs that price today, typically they open with big price upside versus a SPAC is typically going to be trading around 10 or 11 bucks by the time it announces a deal. If the market likes the deal, you can probably still buy it at 12.50 or so. And you look at something like QS, which is at 73 today, hit a high of 87.50, or what are some of the other names out there? SBE, which is at 42. A bunch of names out there that have just gone nuts that started at $10 and their warrants are up triple digits or quadruple digits. VLDR is another one. So I'm a big fan of the SPACs. Again, I think you might have to wait for a little bit of shakeout and start to accumulate these names on a pullback. I highlighted a couple earlier this week, DGAC as well as STPK. I think both of those are pretty interesting. One's a battery play, and one is Sir Richard Branson play. As they haven't announced exactly what they're going to buy, but right now you can buy the common or the warrants at a pretty reasonable price. CVGAC is ran up into the meeting, so I don't know if people were buying it in anticipation of me talking about it today, but it's had a decent little pop over the past 30 minutes or so. So that is one area I like. I was researching, kind of go back to Bitcoin or crypto. I've been talking about crypto a little bit lately. I was researching this new fund. The ticker is BITW, Boy Igloo Tom Water. And the name of this fund is Bitwise 10 Crypto Index Fund. Now, before you buy it, I'm not saying to go buy it here. This is just something I wanted to put on your radar because periodically people will ask me easy ways to get into cryptocurrency without necessarily having to go actually buy Bitcoin itself. And so this one is trading around 25 bucks. I think it might have been started trading today and net asset value is only 1660. So it's trading at a big premium. Ways to get into cryptocurrency without necessarily having to go actually buy Bitcoin itself. And so this one is what is happening here? Trading around.
You got trader audio on your computer, I'm assuming, Damon, so it's just replaying it.
Well, that's okay. We wanted to hear it again anyway. And
just sorry about that. I thought I had trader audio muted, so I apologize for that.
No problem. So that ticker was BITW?
Yes.
Okay, and BITW.
Again, don't buy it here. I was trading at a big premium to NAV. I was trying to save it until the premium narrowed, and it actually did this morning. It narrowed to fell to 2075, and then just took off again. So I was hoping to see the premium maybe narrow down to maybe 15% or so before highlighting it. But it's popped back up. So just something to keep on the radar. But let me read the details of what this does, because it gives you a basket of cryptos versus just Bitcoin. So it says the description: a secure way to get diversified exposure to Bitcoin and leading cryptocurrencies. The fund seeks to hold the 10 most highly valued cryptos, screened and monitored for certain risks, weighted by market cap and rebalanced monthly. And so right now, AUM is 116 million. Bitcoin is 76% of the portfolio. Ethereum 13%. Ripple 6%. Litecoin 1%. Bitcoin Cash 1%. Chainlink 1%. Stellar Lumens 0.7%. EOS 0.6%. And Tezos 0.4%. So for people who are looking for crypto exposure, potentially buying this on a pullback closer to NAV is an interesting way to gain some exposure. But right now it is extremely overvalued.
All right. So where are the levels that you actually do like it then?
So I mean, NAV is 17, it's trading at 25. So I mean, at something like this, I probably it would be more of a timing situation. So if Bitcoin, most of the value is in Bitcoin, most of the portfolio is Bitcoin. So it depends on, what do you want to own Bitcoin as a long-term portfolio holding? So right now, Bitcoin's in the 18,000s or so. I'll probably be looking to buy more Bitcoin related exposure, maybe in the 15s or 16,000s. But again, you'd want to see a closing of the spread between NAV and the stock price before buying this, right? Like, obviously you could just buy Bitcoin at the actual value versus paying 30-40% premium to own a fund just for the convenience of not having to actually open up a crypto account to buy Bitcoin.
All right, I'm curious what you think of MicroStrategy, MSTR. I'm sure you're pretty familiar with what they're doing. They keep buying a bunch of Bitcoin, and will that company go as Bitcoin goes?
I think it has. Stock. I think there was a broker that came out and downgraded it this week when they announced they were doing the convertible offering in order to buy even more Bitcoin. So essentially, it's a software company that has made itself a Bitcoin proxy. That's kind of sloppy. I mean, I think it's had a nice run, but I think at this point you're probably better off just gaining exposure directly to Bitcoin than buying a software company that looks at itself as a Bitcoin trading entity. That's a lot of moving parts, and things can really go wrong there.
Well, it seems like you could probably use Bitcoin as a leading indicator for this one, because if it's already got a high valuation, then any serious drop in Bitcoin would be a very advantageous short opportunity, right?
Yeah, probably so. I mean, that's a good way to look at it, I think. Yeah.
All right, and that was MSTR. All right, so Trend Tracker, we haven't heard from you yet. Look at you. You got involved in the AI IPO. Why don't you talk about it?
Sure. This is just a really compelling opportunity in AI. I mean, obviously everybody knows AI is an attractive space for the future. And as I've been saying, NVIDIA has been really the best way to play AI for years now. Their GPU chips kind of enable this machine learning that all these major tech companies do to work through all the data and do machine learning and all that stuff. I'm not the most technical expert when it comes to this sort of thing, but I obviously understand the importance of the investment theme and the scarcity value. You guys know I like new issues and IPOs. Unity U was one where it's just been on an insane run, and I sold most of it too early. And it was a really strong. It was really attractive because of that scarcity, in that it was a gaming engine. It's software that builds video games. This one, it's trading at a pretty egregious multiple here, above 100, but it's the best way to play AI for the long term. So, it's not growing triple digits like Snowflake is. So, maybe it won't perform like Snowflake did. I was put off by the Snowflake valuation out of the gate, unfortunately. And this one, you can make the same case that the valuation is just obscene. But now at this point here, it's trading at, just under 105. It's got like a low teen, maybe $13-14 billion market cap. And, it's an obscene sales multiple, call it 60 something times sales. But who's to say this $13 or $14 billion company can't be a $20 billion company? It's not already so big, like I believe DoorDash is going to come out at. I don't want to mess up the numbers here, but DoorDash is already it's going to be like 60, 70, 80 billion, I think, when it hits. I'm not going to try and pretend like C3.ai is very cheap, but it is a really compelling opportunity. Tom Siebel is a legend in Silicon Valley, went to University of Illinois, and he was he worked at Oracle early on, then he started his own company, ended up selling it to Oracle. Microsoft and Cook Industries both bought into this deal. Growth has slowed a lot this year because of COVID and because I think of exposure to oil and gas. They're working very closely with a lot of really big companies. And like Palantir, there's going to be a long sales cycle because these are like big deals. So, it might take time for this company to generate some real business momentum, but I mean, there's no reason why it can't grow 50% longer term, in which case it can grow into the valuation. And again, the scarcity value from an investment perspective will be a tailwind that I don't see going away. Of course, if high multiple growth stocks, if software stocks sell off, this one is not going to be immune, but I would think that weakness will present buying opportunities in this one for the long term, because it's really well positioned to be to enable any company to kind of embrace AI in a way that a lot of other companies haven't been able to. So if you watched their roadshow, he made a compelling case about how pretty much any company that is trying to develop their own AI models in-house, a lot of it either doesn't work or it just isn't cost effective. It takes a lot of time, a lot of time for their developers, and these guys have figured it out over the last 10 years. They have a suite that will work with any of the big public clouds. You can just plug in, and within that suite, they have dozens of applications, and a lot of them are industry specific. And he was saying how, this is Siebel, he was saying how, one of the applications basically is a next generation of what Alteryx does, AYX. Another one was, I'm drawing a blank on the other one, but essentially all these different applications within their suite are represented as multi-billion-dollar software companies that already exist. So, I mean, this is a longer-term play. Looks like DoorDash just opened, by the way, 182. Lost my train of thought, but it's a long-term play on AI. It's the best way to play artificial intelligence, which software is becoming increasingly important for every company, and AI is likely to become increasingly important as well. So if you want to stay ahead of the game, then C3.ai is potentially a company that can help you succeed over the long term. So I like it a lot. You guys know that I like these IPOs. A lot of my positions have come public over the last 5 years or so, and I usually do pretty well on them. I mean, there's some that don't perform well, but you definitely have to pay up, kind of hold your nose a little bit sometimes. But yeah, I like this one a lot.
All right, well, somebody was lucky out there. This thing dipped down to 164 in a blink of an eye. So if anybody had a resting bid, the low print on that DoorDash 163.80. So maybe somebody out there was lucky enough to swoop in and get it, and now it's trading 180 DoorDash. All right, well, through that process, we've had a couple of trades hit the board. We have Event Trader buying CCJ, and then Blue Chip just got short Grubhub. So I'll let Event Trader go first.
Yeah, Craig, real quick question on this C3AI. What was the valuation on price to sales?
Well, if you annualize their most recent quarter, it's like 164 million. So if you just kind of take that times 4, it's close to 80 times. But they have really slowed. They only grew 6% in the most recent quarter. So I'm kind of taking that with a grain of salt, assuming it will improve. They do have a lot of oil and gas exposure. They're working closely with big players in different verticals like Microsoft and Baker Hughes and Energy, a French utility player. So the growth. I was hoping the fact that growth has slowed a lot this year would weigh on it, and it wouldn't be as exciting. But obviously, when your ticker's AI, people aren't going to miss this one. And so, if we assume that sales improves a little bit next year, I mean, you can say it's 50, 60 times forward sales, but it's really hard to forecast what the sales are going to do near term. But so yeah, it's pretty much higher than anything but Snowflake. Or it's right up there.
Okay, no, I was just curious. I was just curious because I've been a long-term holder, and my way of getting involved in the AI chip is through the Synopsys SNPS. That trades at about 9.7 times price to sales. So I just throw that on people's radar too. Again, the ticker symbol there is SNPS. Another good way to get involved on the AI chip space. But just circling back, yeah, Jim, I got involved with the CCJ basically 2 days ago. I know Scott and I were taking a look at the uranium space as that saw a big pop. And the Senate Committee on Environment and Public Works passed a bill that approves the establishment of a national uranium strategic reserve. This has bipartisan support in the Senate and is expected to pass in the coming weeks. And I think it's key that this is coming out from the environment area in terms of this is going to really drive some of the mining here. Number one, to import uranium from abroad, so that would bode well for Australia. That's kind of why I had some of those lithium numbers ready for Australia when you and Brett were talking earlier. And it's also should do well for Cameco CCJ, which is more of a domestic company here. It's Canadian-based, I think, technically, but when you look at the CCJ chart here, if you're just looking at it on a weekly, it sets up for a potentially nice breakout above this 13 area. We've been talking a lot the last few weeks about the strength in the miners, and I think CCJ could really see a boost in expectations around this news coming, and we still have to get the bill to pass. But once we do, that sets up as a possible break above 12, and if you just look at it either on a weekly or a monthly, you can see that that sets up as an area of interest where if we get ahead from that, I could easily see us making a push towards 20. So that was the drive behind taking the CCJ, and that's a half-size swing, so a little bit larger position. Looking to hold it for a little bit of a longer time frame to see how this uranium stockpiling increases. So I like that play, CCJ.
Yeah, Gav, so Blue Chip here. We talked about this on Trader Audio the last couple of afternoons. The ETF for uranium is URA, Uncle Robert Alpha, and it's pretty much been dead in the water for like 3 years now. I mean, look at a long-term monthly chart of that ETF, and it really hasn't done much. It has been perking up here in the last 6 months or so, and it did have this recent breakout to fresh 52-week highs above the $13, $12 area, somewhere in that vicinity. A little short-term overextended. But I think CCJ is definitely best of breed when it comes to the few names that are actually out there in the uranium space. I think it's like less than 8 or something like that. But I also like the URA as an alternative if you're looking for ETFs, something that's maybe just spread out amongst the other names there. And I think the URA pays a nice little dividend as well, just over 2% yield. So it's not too bad if you got time to sit around and look at this long-term monthly chart play out. So you're looking at this one as a bigger investment, right, Kev?
Yeah, exactly. So more of a swing play. URNM is another uranium ETF play out there.
Oh, really?
Cameco represent. Yeah, URNM, but I do like URA, lower expense ratio and a little bit more liquidity behind it. But I would note that Cameco is 21% of that URA ETF and about 14% of the URNM. So this is definitely the best in breed.
Cool. And then just to flip back to the AI situation, again, we've heard some good names, Synopsys, NVIDIA, the new stock AI. There are actually tons of ETFs out there as well that have been centralized around this autonomous, artificial intelligence, whatever you want to call it, sort of theme that's been going on there. A couple popular ones. I mean, they've all been running. They've been really, really strong. But I think if you can just keep them on pullbacks, would be prudent in 2021 would be ARKQ. That's ARKQ. Robo, ROBO, is a popular one. There's another one out there, bots, like robots, BOTZ. There's ROBT, RobT. And then there's also IRBO. I think that's the iShares one, IRBO. So you got at least 5 right there that you can just kind of keep track of. Anyway, moving along to Grubhub trade there. Again, as I mentioned earlier, everything's very short-term tactical trading for me these days, given the volatility of the market, the situations that we're in, the trade by appointment only. I laid out this trade about 2 hours ago or an hour ago. That when Dash made its debut, given the all the hype surrounding it, we discussed the fact that people are probably going to be looking to raise money to trade these IPOs, Dash and Airbnb and AI, and in doing so, they're going to kind of just move away from the hotter names that have been out there from the EV space, the SPAC plays, etc. And it's also, you see the market itself is actually under pressure here. I shouldn't ignore that there is some downside activity going on here as semiconductors come, undercutting two-day lows and whatnot, and the NASDAQ and the rest of the market's kind of succumbing to some selling pressure. So Grubhub ran up into the DoorDash debut, as did Uber, and just kind of threw them both out there, saying once DoorDash hype, is out there and makes its debut, I think Grubhub is probably, a decent short, as well as Uber, if you have the means to do so. So it made its debut, and it just followed the plan. And the plan is to get a short on there. We're about $1 in the money already, so a nice little scalp trade there. Definitely warranting taking a little partial profit if you can. I think if Dash comes further back in and the rest of the market continues to sink here this afternoon, I think Grub is going to be a little bit more rewarding for us, possibly going back down to 70, sub 70 level. So just trim and trail from here on out.
All right. I always like it when you guys consider these scalp trades. If they don't work, you can just blame it on him, right? Anyway.
That's not fair. I wouldn't.
Anyway, so all right. Well, we've got the market falling off. I haven't been able to watch the news wires. What's going on in this market that's causing us to drift down to the 3680 level? Anything in particular?
I think semiconductors is what I would blame it on. They've been ridiculously strong here the last few weeks. They started just waning momentum the last 2 days, and then that's really kind of the space that I've been watching that seems to be accelerating to the downside right now. So you're seeing a leading group giving up their gains. To me, that's one of the main culprits.
And I don't see any news. Do you see anything, Gavin?
No, I'm not seeing anything, but just to build off Scott's item, we talked about this earlier with the ST Microelectronics, STM. I still think that that's more company specific, but we laid out a number of the names that had been key drivers, the Microns of the world, and Teradyne, and a few of these names. They're all seeing a little bit of pressure. I think this opens up a nice buying opportunity for them. We got QCOM as well, that's under pressure. So that whole list that we talked about pre-market, Jim, in response to this ST Microelectronics, are all under pressure and starting to see a little bit of an uptick in selling pressure. And then it just kind of builds to what Brett talked about earlier. We've been talking about it for the last couple of weeks since our strategy meeting, where people are just really not protected to the downside. So when we're taking these shots at the shorts, it's under the understanding that it's counter trend. But as we've seen throughout the last 3-4 years, when you get that selling, it usually tends to come pretty quickly and heavily, not looking for that major correction right now, but this is the kind of dip that you could easily expect. Now, I don't see any headlines around it, but we'll see if they come in and defend it. But Scott picking out the semiconductors as a leading downward decline, I would certainly back that up, and I think that stems from the STM micro news we got earlier.
Yeah, the rest of technology falling too. Just looking at IGV, it's down almost 2%, so that's following suit there. All right, gentlemen, so we've gone just about an hour now. Are there any parting shots or themes that you really want to get out there before we break away?
This is Event Trader. I'll putting together a couple of names for my 2021 list, and I'll be writing about them on the site. But one of them, of course, is Salesforce.com, CRM. Still remain a fan of that, coming back in to test the bottom end of its range here today. I think that's just part of the tech sell-off. I'd like to see it hold that 220 area. We had recently added to it, and I could add again if we broke lower. But the other one is AVGO, which probably is also under a little bit of selling pressure here, dipping, but looking for the 5G plays here, and I think that that's going to be a strong theme for 2021. And then just throwing one out on the energy space, but Nextera, NEE, is another name that I would have on my radar. If we could see XLE is still up 1%. That's one of the few strong performers on the session, and we saw it kind of wipe away that horrible data point we saw on oil and continue to just press higher here while the rest of the market sells off. So there are 3 names that I have on my list for 2021 plays, and I'll continue to build off that.
Yeah, this is Trend Tracker. So far, my favorite stock going into, or I guess I should say one of my top picks for 2021 is Lyft. It was also a top pick for 2020, but obviously this year didn't pan out how anybody really expected it to. I'm still kind of thinking through what else would be considered a top pick for 2021, but I do think it's worth mentioning we have some more strong IPOs. Tomorrow we have Airbnb, which is up there with DoorDash in terms of the hype and anticipation. Unlike DoorDash, which saw a boon from the pandemic, Airbnb is actually a recovery play, right? It's a travel stock. So that one will be interesting. It's a pretty compelling opportunity, at least over the long term. I need to dig into it a little bit more. There's also a hydroponic farming, so it's a cannabis play, one coming out tomorrow, HYFM, Hydro Farm Holdings. And then there's some biotechs on Friday, and one is Certara, which is similar to a Schrodinger SDGR or Berkeley Lights BLI, which have both just had huge runs this year since their IPOs. And Certara is also a platform that assists with drug development. So, it's a supplier to the red-hot biopharma industry. And, as we've seen with these vaccines, the revolution, we've basically had a revolution in the biotech space for the last, I don't know, at least 5 years. I don't think that's ever going to really end. So it's it's good for humanity, and so Certara is a nice play on biotech, I suppose, that where you don't have to take that the risk when it comes to a specific drug, whether or not it pans out. So that's why the market is really loving those. And then we have another one that should be coming up. Well, there's still a very strong backlog if we look out to next year, but Roblox is one that might come out soon. I don't think it's scheduled for next week, but it might come out this year, which anybody with kids may be familiar with Roblox. The tickers are going to be RBLX, which is like a social gaming platform, kind of similar to Fortnite, where it's people kind of playing together and it's very popular, but it also has a developer angle to it where people develop their own games and get paid for it, and they have their own currency. It's a very interesting play, kind of represents a next generation of media, which obviously gaming has just been on fire this year, so that's going to be another really, really strong performer, I would think.
All right. Anybody else want to toss in some themes or big ideas they got for next year? Well, if not,
I'll just add
go ahead.
that. So typically you tend to see some type of end-of-year tax loss selling, and I know several subscribers have asked about that. What does our list look like? And energy has been a major underperformer this year, and I've kind of been bullish on energy in anticipation of a Biden win, as well as just the relative value. So I think I still like energy. Energy has been basically straight up over the past couple of weeks. I like some of these names on a pullback. But I just think in terms of the tax loss selling, pretty much everything has gone up except energy and maybe some, I think some financials. I think everything else is pretty much up on the year. So just don't imagine that there's much tax loss selling to be done this year.
And let me just interject there. I think that's a really interesting idea because one of the things that Gavin and I talked about a couple weeks ago, you've had essentially no investment in building out oil supply growth capacity over the last year because of the massive price shock that we saw in April and the sort of PTSD that's come off of that, because anybody who'd been investing in additional capacity just got blown completely out of the water. And there's always been this looming threat of another shutdown or another lockdown, and it's really kept that investment at bay. And when you go this long without new investment, you get to the point where eventually there's going to be a corner return where there's going to be something that's effectively like a supply shortage in the oil market. You're going to see investment come into these companies, and you're going to see the price of oil, the output price for everything they do, probably move higher. So if we get tax loss selling into the end of the year, that could be kind of a really sort of sweet spot idea for companies in the energy sector.
I got a quick question for the team here. With the tax loss selling, do you think that the late end of year value rally that we've seen, is that taking some of the tax selling off? Because I know I've been looking for different areas, and it seems like a lot of the names that I would have had pegged for this, the airlines, the casino names, energy, have all made that bounce. That makes it a little tougher to ascertain that as a January effect type play. Anybody have any thoughts on that?
Sorry, I missed that. What was that, Gav? Could you repeat that?
Yeah, I was curious if anybody had any thoughts on the January effect, because it seems like we've already kind of had things move through there with the value plays already bouncing. A lot of the likely candidates that would have been there as January effects have already bounced. Is there one area where people think that is not really recovered that could continue to fall into that tax loss selling? I know, Brent, you're talking a little bit about energy, but given that bounce, I think that makes it tougher to pigeonhole them directly as a January effect. Or do you think I'm just wrong in that read?
No, yeah.
Well, you look at the XLE, it's down a lot for the year. So, I mean, just in simple terms.
Yeah.
SCALP was saying, it's about the only thing that hasn't come back to really be, to show people gains into the end of the year.
Okay, now that's fair. I wasn't sure. Obviously the XLE is up 28% over the last month.
It's been cut in half from last year.
Yeah, no, that's fair. I mean, that's one of the reasons why I liked NEE. I just wasn't sure if I was reading too much into this bounce or not. Was kind of the key question.
Hey, fellas, I have one more question to get your thoughts on. Now, this is not about tax loss, but tax gains. And in terms of any type of change to capital gains tax, I want to know, is that a 2021 story, or is that something we look forward to the following year?
That's a Georgia vote story, right?
Well, and that's the reason why I brought that up is because if that becomes a 2021 story, we may just have our catalyst to a beginning of the year prick of the market that could be the sell-off. So that's what I wanted to toss out there. This
was something that Carmine and I touched upon in our Monday talk. We specifically discussed the details around this just because of that Georgia vote, and that could certainly fall into a 2021 story. That's something that the market's going to have in the back of its mind for sure, especially given the valuations here.
All right, gentlemen. Anything else you guys want to toss out? I'll give you a going once.
No, that's it for me.
And a going twice. All right, well, then we will wrap this one up and put a bow on it, gentlemen. As always, I thank you for taking time out of your day and getting things assembled for next year. Looking forward to a big year. Hey, we've been bobbing and weaving this market very, very well. I know the listeners out there appreciate that you guys are tossing out some good ideas, and we look forward to doing it all again next year. So, thank you, gentlemen, and thank you, listeners. I will post this in a little bit, so if you missed anything, you'll have this on the archive. Thanks again, guys.
Thank you,
All right,
Jim.
talk to you later, Jim. Thanks.
Jim.